Okay, so unless you've been living under a rock, you've definitely heard of the Magnificent Seven. I mean, these guys are the absolute titans of the stock market right now, the darlings of Wall Street.
You know who I'm talking about. Apple, Microsoft, Nvidia, they're not just gadgets and software. No, these companies have basically been the rocket fuel for the entire stock market lately. I mean, they're seen as the safest, most dominant bets you can possibly make.
But what if all that hype is wrong? See, about a year ago, one investor decided to do something pretty bold. He actually created his own Magnificent Seven portfolio. And it wasn't based on what was popular or trendy. Nope, it was built on a totally different philosophy, with the bet that in the long run, his picks would come out on top. So what was this wild strategy of his? And the big question is, after a full year, did it actually work? Well, let's dig in and find out. All right, so the first year of this challenge is officially over. And the numbers, well, they tell a pretty clear and, for some, pretty surprising story.
And wow, the results are in, and in year one, it wasn't even close. The original Mag 7 soared with a 24.8% return. The challengers' picks, they limped along at just 6%. I mean, if you just look at these numbers, you'd have to say this experiment was a total, complete bust.
But this is where things get really interesting, because when the investor was asked about this pretty terrible result, his response was just zero fear in my eyes. So what gives? Why on earth would someone who just got crushed by the market be so unbelievably confident? It all boils down to how he sees the world.
Yeah, to get why he's not sweating this, we have to look past that one-year scoreboard and really dig into his core philosophy. It's basically a showdown between two big ideas: paying a price versus buying into hype.
And this simple analogy he uses just nails it. Think about it. A cell phone is worth, say, $1,000. If you can get it for $300, you're going to do great. But if you pay $2,000 for it, not so much. It's not about how awesome the phone is. It's all about the price you paid. A fantastic product bought at a crazy high price is still a bad investment. And that simple idea, that's the bedrock of his whole strategy. This really gets to the heart of it. See, price is just the sticker on the box. It's what everyone's paying today. Value, though, that's what the company's actually worth, based on real stuff like profits and cash flow. The whole game, for him, is to find these awesome businesses where the price tag has just gone completely haywire and doesn't reflect the true value anymore. And he's got this great metaphor for it. He says, in the short run, the stock market is basically a voting machine. It's just a big popularity contest, right? Hype, feelings, what's trending, that's what moves prices. But in the long run, it turns into a weighing machine. And eventually the real fundamentals, the actual substance of a business, is what really matters. And his entire strategy is a bet on that weighing machine.
Okay, so that's the theory. But what does this actually look like in the real world? Let's take a peek at a couple of the companies in his challenger portfolio.
All right, first up, PayPal. Now, you probably remember this company was once a total stock market darling, a leader in its field, everybody loved it, but lately, Wall Street has just completely abandoned it.
And this is where you see that crazy disconnect. Look at this. Over the last 5 years, the stock price has just been hammered, down 74%. That's the voting machine in action, right? Pure negative sentiment. But over the last 10 years, the actual business's revenue, it's up 250%. The company got stronger, but the stock got way cheaper. For an investor like him, that gap is everything. That's the opportunity. And this quote just says it all. The bet isn't that PayPal is some perfect company with no problems. No. The bet is that the market got so down on it, so negative, that the stock price completely disconnected from the reality of what is still a very profitable growing business. That's the moment you step in. Now here's another pick that might make you raise an eyebrow. Southwest Airlines. I mean, we all know the airline industry is just brutal, but Southwest has always been different, a real standout, until recently when they've hit some serious turbulence. So the whole idea here boils down to this. Before COVID, Southwest was a cash printing machine. Think about it, consistent 10–15% profit margins, and get this, 47 years in a row of being profitable. Lately though, that margin has crashed to just 1.4%. So the bet is simple. You're guessing these problems are temporary. You're buying a historically amazing company while it's down and out, betting that it can get its act together and return to form. So when you zoom out, you really start to see the bigger picture here. This whole strategy isn't about chasing the latest hot stock. It's about a patient, disciplined approach that's built for the long haul. You can really break it down into 4 key steps.
Number 1, you have to be obsessed with the gap between the price you pay and the value you're actually getting. 2, you have to be okay with looking kind of dumb in the short term, because remember, it's just a popularity contest. 3, you've got to have the guts to trust that over time, the real business fundamentals will win. And finally, you can never, ever forget the most important rule of all.
And it's this. This is really the whole thing in a nutshell. The Magnificent Seven, they're amazing companies with great stories, no doubt. But even the most incredible story can become a horrible investment if you pay too much for it. The price you pay, that's what ultimately decides how you're going to do.
And that really leaves us with one big question to ask ourselves, right? When you're investing your own money, are you buying a popular story or are you buying a business at a good price? Because thinking about that, well, that could make all the difference in the world.